Welcome to My Money Mindset podcast, where we explore how a healthy mindset is the foundation for financial success. Each week, we delve into mindset hacks and practical strategies to help you enhance your income, help you make more appropriate investments for yourself, and to improve your overall financial well-being. Join us on this journey to transform your financial future by transforming your mindset. Please note that the information provided on this podcast is for general information purposes only and does not constitute as personal, financial or health advice. It has been prepared without considering your individual objectives, financial situation or life needs. Before making any financial or health decisions, you should consult with a qualified professional or financial advisor to ensure the information aligns with your specific circumstances. So let's begin and enjoy this journey as each episode teaches us on how to improve our overall mindset that overall improves our financial success. Hello everyone and welcome to another episode of Money Mindset. Today I'm going to talk about what's actually on a lot of people's minds, or the concerns of a lot of the calls and emails that I've been receiving with potential investors and wannabe investors and investors currently in Australia. So it's probably a good episode if you are considering wanting to buy a property, buy shares, invest more money, find out exactly what to invest in or what to do with your money, how to sort of invest it in the next short-term sort of market. Now, today investors in the there's a few concerns in the property market, Australian property market. Number one is obviously the first one, which is obviously the cash rate. Possibility that if there are future hikes, is that going to help hold property? Land tax was another thing. In certain states, it's gone astronomical, so that's the holding cost, right? So the first thing I really want to talk about is interest rates and the borrowing costs. So a cash rate can fluctuate, as what we have known to experience very, very short time ago. We are hoping that the cash rate does eventually start dropping. That's obviously under the inflation and a few other economic factors. But what we want to do is make sure that future rate hikes are sort of slowing down or not really going to happen. Now, if they don't, they start slowing down, we've got to read the market. And if there is a dip in interest rates, commonly that means that it's going to incentivize people to borrow money or more money to buy property, right? So for investors that are looking in the property market, there is a cash rate drop that we're hoping will occur very soon. That just means that obviously it's going to reduce potential repayments on current investments and potentially drive the value of that property up. So that's probably the main concern, is number one, that sort of reaches a lot of people's mind, right? And obviously the borrowing costs with that, obviously a higher interest rate, it's going to mean that it's going to cost more to hold that property. So let's wait and see what happens with the rates. If they do drop, if they only drop a little bit, they sustain and then bounce back up. Commonly in the history of Australia, we're seeing that most of the time when they're trying to slow inflation down. So the reason why we did find that there was an interest rate hike or cash rate hike was simply because the RBA were trying to slow inflation down. The only tool that they have to slow inflation down is to literally bring the interest rate and slow consumer spending, right? Because consumer spending is a major factor to driving inflation. The higher the spending, higher the inflation. So therefore, to counterbalance that, they introduce higher cash rates. So the banks will then introduce higher interest rates, right, to slow that down. Now, the other thing was that, confidence with investors, with property and rates, because a lot of people who have just recently started investing in property, especially in the last 10 years, have never seen rates go up. So someone that's, bought a house in the last 8 years, let's say, had only probably experienced rates sort of going down. but now they're bouncing up. And what does that do? Well, 8 to 10 years later, it knocks the confidence out of you, and you think, oh, gee whiz, that was a bad experience. I could have lost my investment property, or could have lost our home. So it cracks the motivation a little bit down, right? So that's ultimately what a lot of investors look out for now, is that they don't want to re-experience that. The other thing too, what investors should be looking out for is an economic slowdown, because obviously an economic slowdown is going to affect consumer confidence. They sort of go hand in hand. Now, I'm not going to get into GDP growth, gross domestic product, and all that sort of woo-ha. I don't think that sort of really affects too many people, although if you are into a lot of that sort of, watching the ASX and a lot of the markets, international and stuff, it will. What we just got to be mindful as a basic investor, or wannabe investor, or property owners and business owners, is weaker consumer confidence, that knocks the crap out of the economy. If the consumers don't have confidence, especially in political parties, or if cash rates are going up, then their spending does not happen. So what we're finding is, going back to why inflation occurs, because of consumer spending, what we might find now is that if interest rates drop, then the confidence may come back, but don't gamble with it. It may not come back. And what I'm saying is, a lot of people, as opposed to after they've experienced what a rate hike does, they probably say, well, I'm still a little bit hesitant, I'm going to wait and see. And they may ask for another rate drop, or wait for more rate drops, right? I've seen that a lot of the time, especially with some of my clients that are used to be really into risk and borrow, and they now are sort of thinking 2 or 3 times before they actually get into an investment. So now the other thing that is affecting is, obviously you would have heard on the news, is housing supply, and obviously all the construction costs that are associated with it. The governments keep saying, and their efforts to increase housing supply is really not happening as what it should be, especially if our population or immigration starts to increase. All of a sudden we need people to live in places, right? So the government really needs to have a look at that. But the problem with this is their rising building costs with constructions, getting the right tradesmen, the quality of the build is another thing. How many times do we see on these shows on the news that the quality builds have been absolutely dismal, and a lot of people, the poor things, are got water leaks going through the building, and they haven't, it's just poor workmanship, and this just literally drives the motivation out of people to say, well, no longer am I dealing with brand new, even though I can claim depreciation and have all the advantages. Or first home owners, they get the grants, and they're scared. People are scared to invest in poor workmanship. There's nothing worse than getting something that's brand new and it's got more problems than the early settlers when it comes to moving into this property that's leaking, right? Or if it's an investment and you got tenants in there that you need to subsidise them and give them cheaper rent because it's a podgy house, and then you've got to chase the builder, and that knocks the crap out of people's confidence, especially investors that have had this done to them before. So you wouldn't blame them, right? So now I want to get on to the other thing when it comes to sort of rental, as in the rental market, the dynamics and the affordability. Rental growth is sort of, it's slowed from the peak. It started to go up and was starting to go up in accordance with interest rates and stuff like that. What we found that investors were saying, well, I got to, my land tax has gone up and my interest rates are gone up, so now I've got to pass that bill over to the renters to pay it off. I don't want to cop the bill, or my investment property isn't returning as much as what it should be because of these extra costs, so I'm going to increase the rent. But there comes a time when that rent, or the cost of the rent that you can charge, caps off, right? So people then start saying, well, I'm not paying that ridiculous rent off. You're asking too much. If there's a slight rise in interest rate and they've got to push the rents up again, and then you've got another investor next door that literally doesn't pass on that rate hike, well, guess what? These properties are going to get filled in before the other one where the rent prices are too high or ridiculously high. We actually found that's happening a bit with a lot of the properties, the short-term stay properties, holiday stays, where they're not, there's a lot of more taxes involved and a lot more costs that have been implemented onto short-term stays. So the investors in that area are sort of starting to think, is it worthwhile having it? Some yes, some no. I still do a lot of the finance for a lot of my investors that are still persevering with the short-term stays, and some are successful and some not so, but it definitely has slowed down, and you've got to keep an eye on it. The other thing what other investors are sort of looking out for is government policy. The elections that have just passed by, that sort of did have a lot of effect. Potential changes in government really, if they change negative gearing, or if capital gains tax is increased, or there's another tax that's implemented, this knocks the crap out of people's confidence, right? Investors don't want costs on top of costs, and 9 times out of 10 these costs can be associated more with the property game. What's trying to happen here? Well, we're not really sure. I mean, the age-old argument is if you make housing less affordable, then you make it less affordable not only for the people struggling to get in the market, but for investors to be able to buy houses to rent them out, right? So there's a catch-22, and if prices don't go up and people aren't getting the money back or the returns back on the investment, they end up selling the house and providing it to someone else. It still doesn't fix the housing problem or the construction of more houses for people. So it's sort of, it drops a lot of the living standard and affects the economic living standards overall, and can somewhat increase crime and all that sort of stuff, right? So you really got to be mindful of that. Government policies and regulation changes really can knock the crap out of people's confidence, and that's associated with rentals. Renters now these days have a lot more say in the way that they, in rent, and there's a lot of policies now that protect the renters where they used to be, and that sort of makes the landlord a little bit nervous, because if they're a podgy landlord and they're not really providing a good accommodation, it can sort of, the renters can turn up and really put their finger down. There's a lot of controversy about this. Where do you draw the line where someone's got a lot more power? If the renter can demand certain aspects, it affects the investor's return on their investment, and so on and so forth, right? So that policy within having a government policy change to enhance a renter's ability to sort of be more favourable to the renter than the property landlord, then you'll find that the landlord can tend to lose a lot of taste into investing in property and invest elsewhere, right? So we've got to really make sure that the increase in government intervention in the rental market stays not too high. It stays where it is and doesn't really tip the scales to the advantage of the renters. Doesn't necessarily mean it's got to tip the scales toward the landlord, but there's got to be an even keel. There's got to be a happy medium, just like anything in life, right? So that's why there are a lot of investors, or even some of my clients, are considering selling or shifting to short-term rentals, even though they have copped a few tax increases with that and fee increases. But they're saying, well, rather than selling the property, that's what we're going to do. The other thing that creates a lot of problems that does not help investors is the market volatility, price corrections, all that sort of stuff, things that are out of our control type of thing, slower growth, property prices that fluctuate simply because of other economic influences. You've got also geopolitical risks, global economic uncertainties. So for instance, those of you that have been looking at what's happening over in the US, I just did a short episode in regards to how that affects us. We've got to make sure that doesn't create this motivation to the investors. I mean, all these factors it's all about, having confidence, right? And these are the things that knock the crap out of any investor's confidence. And it also associates itself with shares. I mean, if you listen to the episode in regards to US tariffs, I do a comparison how that affects share prices, right? So if you're more into investing in shares more than property, you'll find that also doesn't help a lot of investors out there. The last thing is tenant risks and property management, concerns about having tenant defaults, property damages, the difficulty in finding and retaining quality clients. That can be really hard. Effective property management, landlord insurance is another one. Insurance has gone up through the roof, so that's another thing to be aware of. I hope that this all made sense, and hit me up if it doesn't, and see you on the next episode. Thanks, guys.